Welcome to the deep dive. This is where we take that just absolute fire hose of information you see every day and distill it down into what you actually need to know.
And today we are diving headfirst into a conflict that, it really does perfectly symbolize the current state of the U.S. economy. We're talking about this huge chasm between corporate hype and what executives are actually doing with their own money.
We have to start with the language of it all.
Like,
The words themselves are just so crucial to setting the scene here. We are talking about Alex Karp. He's the CEO of Palantir Technologies.
right.
And after a really famous investor bet against his company, he went on national television and just unleashed this torrent of incredibly aggressive language. He claimed that anyone betting against Palantir was, and this is a direct quote, crazy.
And he didn't stop there. He also called them batshit crazy.
Batshit crazy, yeah.
And that emotional intensity, that's really key. This wasn't some, standard corporate press release or a calm defense. He immediately pivoted from insulting the critics to positioning his company as like a global necessity.
He actually declared with a straight face that Palantir was, quote, clearly the most important software company in America and therefore in the world.
More important than Microsoft or Google, apparently.
Right. So, okay, let's unpack this because our deep dive today is into that massive, ethically, just fraught gap between what corporate leadership tells the public.
Especially the average person, the retail investor.
Exactly. What they tell them versus what those same executives are doing with their own multi-billion-dollar stock holdings. The sources we're looking at describe this pattern, with Palantir as the poster child,
Right.
as an instance of just insane hypocrisy.
And an extremely unethical double moral. That's the phrase they use. This is the perfect, almost textbook symbol of the financialized U.S. economy, which the sources argue is built on these really unstable bubbles.
Bubbles inflated by hype.
Constantly. And in that environment, the information asymmetry, the simple fact that executives know way more than the public, that gets weaponized. It allows for this staggering transfer of wealth, and Palantir is our case study for exactly how that mechanism works.
Absolutely. So our mission for the next 30, 40 minutes is to follow the money, but also follow the words. We're going to detail the CEO's very aggressive public rhetoric.
And then contrast it with the documented, $1.9 billion in personal stock sales he made.
It's an incredible number.
Yeah.
And we'll analyze this cynical concept of exit liquidity and place this entire ethical mess in the context of this irrational AI market bubble that is sweeping the globe. You really need to know how these mechanics work, not just understand the news, but frankly to protect your own savings.
Your retirement, all of it.
Okay, so to really grasp the severity here, we have to start with the market context. The almost statistical irrationality of Palantir's valuation when Karp made those comments.
Right. The sources we're drawing from describe the U.S. stock market right now as an enormous bubble, potentially one of the largest in history, and it's mostly being driven by this frenzy around AI.
And when you think AI hype, you probably think of NVIDIA, the chip maker.
Or OpenAI, Microsoft, Meta.
Exactly. But Palantir, which is at its core a very specialized government data and surveillance software company, has been riding that AI wave relentlessly. Its stock just shot up starting in November 2024.
But here's the baseline fact you have to remember. Until 2023, Palantir was consistently losing money.
Not growing as fast as they'd like. Losing money.
Losing money year after year. Now, when a company finally makes that switch from losses to, sustained profitability, investors use standard tools to analyze it. And the most important one is the price-to-earnings ratio, the PE ratio.
And this is just a measure of how expensive a stock is compared to the money the company actually makes, right?
That's all it is. Stock price compared to per-share earnings.
Okay, let's put this in context, because the Palantir numbers are so extreme they can sound like a typo if you don't have a baseline.
They really can. So if you look at the S&P 500, that's the index of the 500 biggest U.S. companies, the historical average PE ratio is around 20.
So on average, investors are willing to pay $20 for every $1 a company currently earns.
Yeah.
That's sort of the historical benchmark for value.
Exactly. Now, even in the middle of all this current market euphoria, this irrational exuberance, the average PE for the S&P 500 in 2025 was sitting around 29.
Okay, so 29 is already a bit bubbly, a bit expensive compared to history.
It is. It shows the whole market is a little overvalued, but it's still, within a recognizable band. It's not completely detached from reality.
And now we get to Palantir. This is the financial shock. Compare those numbers, 20 for the average, maybe 29 for a bubbly market, to Palantir's peak PE ratio at the end of June 2025, just a few months before Karp's rant. Palantir's PE ratio hit an absolutely insane, cartoonish level of 454.
550.
It's a meaningless number on its own.
It is. It's statistically off the charts. To put that in perspective, a super successful, fast-growing tech company, one that everyone agrees is revolutionary, might trade at a PE of, say, 80, maybe 100 during a massive growth spurt.
Right.
But 454, that suggests investors were basically betting the company's earnings would have to increase by something like 20 times just to get back to the average market valuation.
So it's the valuation based on just pure abstract hope. It has nothing to do with financial reality.
Yeah.
And even after the stock started to fall in November 2025, it was still near 370.
The sources are crystal clear on this. That ratio demonstrates, without a doubt, that the stock was trading at completely irrational levels. It was totally decoupled from any underlying fundamentals. It was just pure speculative mania driving that price.
This level of hysteria, I mean, where the price has no connection to the actual value, that's exactly what draws in the skeptics, the professional investors who look for these kinds of disconnects.
And that perfectly sets the stage for the big catalyst here. The public bet made by Michael Burry.
The Michael Burry.
Yep, the guy from The Big Short, famous for correctly betting against the housing bubble in 2008. He publicly disclosed that he had taken put options, which is just a direct bet that the stock price is going to fall against Palantir.
And the timing here is just fascinating. It created this immediate tension. Burry's disclosure came out just as Palantir released what looked like a really positive quarterly report.
Showing strong growth, yeah.
But the stock still fell significantly after the news of Burry shorting it got out. And that tells you everything. Even good news couldn't overcome the signal that a heavyweight like Burry thought the valuation was just an unstable bubble waiting to pop.
And that loss of momentum, that's what triggered Alex Karp's very dramatic, very personal, and very public reaction. It wasn't just a financial challenge to him. It was a challenge to the whole narrative of untouchable superiority they were trying to build.
He responded by escalating it from, a financial disagreement into something that sounded a lot more like a moral battle.
Yeah, and that's where we move from the spreadsheets into the raw emotion and the corporate rhetoric.
Following Burry's short, Alex Karp sits down for this interview on CNBC. And the whole thing is it's intensely emotional, aggressive, almost shockingly defensive.
He took the bet personally, like it was an act of sabotage. He said that shorting his company was super triggering.
Super triggering.
Because in his view, Palantir isn't just selling software. It's doing this noble AI work for Western interests.
Yeah.
He framed a decision to short the company not as a financial calculation, but as something batshit crazy.
He was trying to demonize the critics.
Yeah.
He used this us versus them language, implying that short sellers weren't just making a risk assessment, but that they were these ideological manipulators driven by malice.
It's a classic deflection, right? Turn a critique of your valuation into a moral failing on the part of the critic.
And his claims about the company were just as startling as his attacks. He said over and over that Palantir was one of the great businesses of the world.
And then came the big one. Clearly the most important software company in America and therefore in the world.
You just have to pause and absorb the audacity of that. A claim of superiority over Microsoft, Google, Amazon. Every software giant on the planet.
And he's making this claim at the exact moment when financial experts are pointing out that his company's valuation is completely irrational. It's not just confidence. It's an attempt to dictate reality to the market.
He even said the scrutiny was crazy motivating and that he was driven, in part, honestly, to make them poorer, talking about short sellers. He said he'd be dancing around when they lost all their money.
But here's the most ethically charged part of this whole rant, the most significant part. It was his direct plea to the average person.
Right. He wasn't just talking to institutional investors.
Not at all. He directly encouraged average people, he called them people not in the investor class, the mom and pop investors, to buy more and more Palantir stock. He told them it would make them rich.
And that is the pivotal moment. That's the double standard in action. He's on his massive platform as a CEO, telling non-experts to pile their savings, their retirement funds, into a stock that the sources are calling insanely overvalued and bubbly.
He framed it as this populist fight, like he was fighting the big Wall Street players on behalf of the little guy.
And that's the hypocrisy signal, right? It's just blaring. This aggressive emotional promotion of this crazy valued stock was aimed right at the people whose financial future depended on his guidance. He was telling them to buy into his vision.
A vision that, as we're about to see, he and his inner circle were already systematically cashing out of for their own personal gain.
We go from public rhetoric to private reality in just a couple of weeks.
And this next section, it really does reveal the shocking contradiction. All that noise, all that passion on CNBC was followed by this quiet but devastating action.
Let's nail down the timeline, because the gap is what really demonstrates the hypocrisy. Just 16 days. Only 16 days after Alex Karp went on TV calling short sellers crazy and batshit crazy, he and other top Palantir executives initiated a massive, coordinated stock sell-off. The timing here just screams that they knew the bubble was shaky, and it was time to cash out before the correction.
And this isn't speculation. This is according to documents filed with the SEC, the Securities and Exchange Commission, a coordinated sell-off on one specific day, November 20th, that involved more than $200 million worth of shares liquidated by 5 top executives.
5. This wasn't one guy diversifying his portfolio. This was the core leadership, synchronized, heading for the exit.
Let's break down those numbers. On that single day, less than 3 weeks after the CEO's big rallying cry,
Alex Karp himself, the man who was going to dance on the graves of short sellers, he personally sold $96 million worth of his shares.
wow, 96 million.
Then you have Stephen Cohen, the president and a co-founder. He sold $66 million.
66. Okay.
The CTO, Shyam Sankar, who had only just become a billionaire in 2025 because of this bubble, he sold $37 million.
And a couple others too, right?
Yeah, the CFO, David Glazer, and the Chief Revenue Officer, Ryan Taylor, they sold another $4 million each.
The collective impact of that. 5 senior leaders liquidating over $200 million just 2 weeks after the CEO gives this massive buy signal to the public. It's undeniable.
It shows a complete lack of confidence in the future valuation they were just screaming about. But that $96 million for Karp, as staggering as that is,
Yeah.
that barely even scratches the surface.
That's the truly mind-blowing statistic, isn't it?
It is. The full scope of Alex Karp's total sales from 2024 up to March 2025, it exceeded an almost incomprehensible $1.9 billion.
1.9 billion.
And that's on top of the $96 million from that one day in November.
We have to pause on that number. A billion is an abstract concept. That amount of wealth is more than the GDP of several small countries. It would take a typical American worker, 38,000 years to earn that?
It's a monumental fortune, extracted from the company right at its absolute peak of hype.
And it wasn't a one-off thing, it was systematic. The SEC filings show Palantir execs were selling shares almost every single month from March through October of 2025, leading up to that big synchronized sale in November.
What was the total figure over that period?
The sources cite total insider sales over a 24-month period of over $3.38 billion.
$3.38 billion, wow.
That's about 68 million shares sold by key insiders. Now, the sources are careful to point out that insider selling on its own is not automatically illegal. And this is what we need to talk about, the mechanism they use, the thing that gives them plausible deniability.
The 10b5-1 plan.
Exactly. The 10b5-1 plan.
Let's spend a minute on this because it's the regulatory, loophole. It's at the heart of the ethical problem here. What is it?
So a 10b5-1 plan is basically a prearranged trading contract. An executive sets it up at a time when they are not in possession of any secret material information. The plan might say something like, I will automatically sell 10,000 shares on the first Monday of every month for the next year. Once it's set up, those sales happen automatically, no matter what the executive knows at the time of the sale. It's designed to protect them from insider trading accusations.
So on the surface, they can just say, look, my sales were automatic, they were scheduled way in advance, they have nothing to do with what I said on TV last week.
That's the defense.
But where's the ethical catch?
The catch is all about the timing and that information asymmetry we talked about. An executive knows when their company's stock is floating in a hype bubble. They know when they're about to go on a media tour to pump the stock even higher. They can set up or adjust their 10b5-1 plan right before that hype cycle.
So the sale itself might be automatic, but the decision to set the plan in the first place, the decision to sell billions of dollars at that specific bubbly price point, that's a conscious, profit-driven choice.
Precisely. And when you pair that systematic selling, legitimized by a 10b5-1 plan, with the aggressive public promotion of an insanely overvalued stock, it just signals this profound, almost cynical lack of alignment.
Their actions show they were securing their own financial future at the exact moment they were encouraging average people to bet theirs on the stock going even higher.
The legal mechanism is being used to facilitate what is, according to the sources, an extremely unethical outcome. Executives monetizing the very enthusiasm that they personally generated.
Which leads us right to the core of this ethical conflict. It's all about that concept you mentioned, information asymmetry.
It's the single most important factor. Executives have the deepest, most nuanced insight into their company's real prospects, the risks, and whether a valuation of 454 times earnings is actually sustainable.
And when they systematically sell off these huge chunks of their holdings, especially during a period of record hype, it sends a powerful signal. It doesn't matter what they're saying publicly. The signal from their actions is, we ourselves do not believe the stock can stay this high.
The selling directly contradicts the public message of long-term commitment. And this is where the sources really transition from just describing what happened to indicting the behavior. They argue that this whole practice allows executives to cash out and secure these multi-billion-dollar fortunes by exploiting the hype they helped create.
So let's get specific. For the average person who listened to Alex Karp on TV and bought the stock, what does this mean? It means the corporate leadership is securing their wealth by using the savings and retirement funds of average investors to provide what's cynically called exit liquidity.
Yeah, let's break down exit liquidity. It's a crucial term. Imagine an executive wants to sell, say, $100 million worth of their stock.
Okay.
For that sale to actually happen, $100 million of new money has to come into the market from buyers who are willing to pay that high price.
And those buyers are the retail investors, the ones who heard the CEO's pitch.
Exactly. The money that the mom and pop investors pour in to buy the stock at its peak bubble price is the very same money that allows the executives to sell their own holdings and walk away rich. The retail investor provides the cash, the liquidity for the executive to exit their position.
It's the ultimate game of hot potato. The executive is handing this overvalued asset to the retail investor, basically guaranteeing that the average person is left holding the bag when the price eventually corrects back down to a more rational level.
The narrative presented in the sources is incredibly cynical. It's that executives, including Karp, they recognized the stock was in a crazy bubble, totally detached from fundamentals, and that knowledge prompted them to liquidate their holdings at the direct expense of the average investors who piled in based on their public assurances.
And this is why the sources just keep coming back to these phrases, insanely hypocritical and a double moral. The simultaneous encouragement to buy, while privately and systematically selling billions, it completely undermines trust in corporate communication. It raises these fundamental questions about what ethical governance even means in the modern market.
When the people with the most information are running for the exits while telling everyone else to rush in, that's the literal definition of exploitation through information asymmetry. It damages the stock price, sure, but it also damages the entire foundation of investor confidence.
It teaches the public that a CEO's word is just a form of propaganda designed to secure personal wealth, not a genuine guide to value.
And to really understand the scale of this bubble and the risks involved, you have to acknowledge that Palantir is not your typical software company.
Right. Its whole business model is tangled up in government contracts, surveillance, politics,
Yeah.
which both fueled the hype and injected this massive systemic risk.
The stock spike, the very bubble that allowed this massive insider sell-off, was heavily influenced by political expectations. It started inflating in November 2024, right after the election, because investors correctly assumed a returning Trump administration would just shower Palantir with favorable contracts.
And they were right. I mean, the administration gave Palantir almost $1 billion worth of contracts in just the first 2 months of 2025.
Now, that kind of politically driven revenue can justify some growth, sure, but it can't justify a PE ratio of 454.
And a big chunk of that work was for Palantir to conduct mass surveillance on Americans. The sources describe its software sifting through huge data sets from the DoD, the CIA, law enforcement, basically to build these detailed profiles on U.S. citizens.
They call it the kind of activity you'd associate with a dystopian regime.
And this is the core of their business. Palantir is a critical piece of the Western military-industrial complex. Alex Karp himself has said the U.S. is preparing for potential three-front wars against Iran, Russia, and China, and Palantir's tech is seen as essential for all of that.
Which means its revenue relies heavily on a single client, the U.S. government. And that dependency is amplified by a specific political party being in power.
That skyrockets the risk profile. A change in administration, a shift in policy, and their revenue stream could be compromised overnight.
Exactly. And you can't separate the business from the ideology, especially with the influence of co-founder Peter Thiel.
Thiel is a huge force in conservative politics. He backs candidates who want to limit democratic institutions, and he's publicly said, and this quote is just striking, that he doesn't believe freedom and democracy are compatible.
Which just shows that Palantir is more than just a data company. It's an ideological project. Its politics dictate its business model. So when the CEO is pumping the stock, he's not just promoting software, he's promoting a specific ideological and military project.
And that kind of controversial work brings intense global scrutiny, which you'd think would dampen investor enthusiasm in a rational market.
You would think. I mean, Amnesty International put out a report warning that Palantir's work with ICE deportation systems created severe human rights risks.
Right, using its software to map and track undocumented migrants.
And it's not just in the US. In UK, they won this massive contract with the National Health Service, the NHS, worth up to £450 million. But that's now facing judicial reviews over concerns about centralizing all that sensitive patient data.
The fear is that they're locking the state into their proprietary systems.
So when you're looking at that PE ratio of 454, an informed investor has to factor in all of this systemic, legal, and ethical risk that just naturally follows a company whose main business is enabling mass surveillance. It just underscores how truly irrational that valuation was.
Okay, so this deep dive really gives us a framework for analyzing corporate behavior that goes way beyond just, a quarterly earnings report
Yeah.
or a CEO's soundbite.
We can basically synthesize the 4 core factors that were all happening at once, all signaling this profound lack of alignment between the management and the public.
First, you have the aggressive and frequent insider selling. Over $3.3 billion in 24 months. That's a systematic divestment strategy.
Second, the high, irrational valuation. The PE ratio of 454, just totally divorced from reality.
Third is the broad market hysteria. The AI hype wave, plus the specific political enthusiasm, created this really unstable, speculative environment that was just ripe for exploitation.
And fourth, the direct public encouragement to buy. The CEO repeatedly and emotionally telling non-experts to jump into the mania.
The critical insight here, the thing you need to take away to protect your own money, is to just watch the gap between what the management says and what they do.
Yeah.
Their words on TV promoted this grand, world-saving vision, the most important software company in the world.
But their actions, detailed in those boring SEC filings, secured billions in personal wealth by systematically liquidating their own stake in that very vision. The most valuable piece of data for an investor wasn't the positive quarterly report. It was the filing that showed the $200 million synchronized sell-off just 16 days after the CEO's rant.
That action revealed the true management perspective way more than any rhetoric ever could. And you have to just think about the cognitive dissonance there. Imagine being Alex Karp, sitting in that interview, passionately insulting skeptics, telling everyone your company's the future, knowing that a pre-scheduled massive liquidation of your own shares is set to execute in 2 weeks.
The sources basically paint that as the functional reality of securing personal wealth in a bubble.
So the lesson for you, the learner, is to treat insider selling, especially at this scale, as a vital piece of your analysis. Don't just dismiss it as diversification if the people who know the most are quietly taking billions off the table.
You should treat their enthusiastic verbal assurances with extreme skepticism. That knowledge is your primary defense against propaganda. This whole thing is a reflection of a cynical business model where executives exploit the average person's hope and turn it into their own exit capital.
This isn't just a story about Palantir, it's a manual for how bubbles transfer wealth upward.
And in the end, the Palantir example is just this potent, really uncomfortable reminder that in our financialized economy, built around this information asymmetry, you get a tale of 2 cities. There's one city for the corporate class who time their exits and cash out as billionaires, and there's another city for the average person, the retail investor, who is often left providing that exit liquidity and taking the hit when the bubble finally deflates and the price crashes back toward reality. And while the sources describe this as insanely hypocritical and extremely unethical, we also noted that these sales are often done through legal structures, these 10b5-1 plans. The executives can claim they were acting within the letter of the law.
They can and they do. So if this exploitation of retail investors through misleading signals and massive liquidation is systemic, if this gap between what executives say and do is consistently this large, and if they can use these planned structures to give themselves legal cover for what is clearly an ethical double standard, You have to ask, is our current regulatory framework enough? What happens when legality and ethics diverge this sharply, allowing billions to be transferred from the retirement funds of average people to the personal bank accounts of corporate leaders? That's the fundamental conflict that remains for you to consider as you navigate this market.